Hey guys, it is Julie here with TipRanks. In today's video, we're taking a look at 3 trending stocks that have picked up some recent buy ratings and have some pretty attractive double-digit upside potential. So let's get into it. Alright guys, welcome back and thank you all so much for being here. Like I said, today we're looking at trending stocks. Now to find these, we used the TipRanks Trending Stocks Research tool. With this tool, we can take a look at stocks that have been rated by 3 or more analysts recently. So we're looking at the best rated from the last 72 hours. So we're going to take a look at what these companies do and what has analysts feeling so bullish lately. Just before we get into all of that, this is your friendly reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Okay, let's dive right into these 3 trending stocks. The first on our list today is a company called Cheniere Energy. Their stock trades under the ticker LNG and is currently priced at about $89 per share. Cheniere Energy is a liquefied natural gas company based out of Texas, and they actually became the first American company to export liquefied natural gas back in 2016. Initially an oil and gas exploration company, the company shifted its focus in the early 2000s to developing liquefied natural gas regas terminals, beginning with a terminal in Sabine Pass, Louisiana back in 2005. Now they are the second largest LNG operator and 4th largest LNG supplier globally. Their long-term contracts form the foundation of their business model, with over $6 billion in annual fixed fees take-or-pay style revenues. Their liquefaction platform is about 90% contracted, with the weighted average remaining life of long-term contracts at about 18 years. At the beginning of August, Cheniere Energy did share their second quarter earnings report, where both their earnings and revenues did fall short of analyst expectations. The company reported adjusted earnings per share of 54 cents in their second quarter, missing the estimates of 92 cents and falling short of the previous year's quarter at 78 cents per share. Their quarterly revenues did rise over 25% to $3.02 billion from $2.4 billion a year ago. The company posted an adjusted EBITDA of $1.02 billion, which was down from the year prior. So with these lackluster second quarter earnings results, you might be wondering why this stock is trending with analysts recently. Well, just yesterday, the company announced a long-term capital allocation program. This comprehensive plan includes $1 billion of debt paydown per year until investment-grade metrics are achieved. They also initiated a quarterly dividend starting at 33 cents per share. They'll have share repurchases resuming in the third quarter, and their Corpus Christi Stage 3 FID is expected in 2022. So following this updated capital allocation plan, we've had several analysts weigh in with reiterated price targets. One of them is 5-star analyst Benjamin Nolan. He says that none of the announcements were surprising and that the 33 cents per share quarterly dividend was in the range of expectations. He still believes that revised strategy paired with a strong near-term market should improve cash flows and drive the share price even higher. Benjamin is one of 10 analysts that have a current rating on the stock, and it comes in with unanimous buys. The average price target comes in at $105.22, which would be an upside potential of 17.9% over this next year. On the low end, we do have a buy rating from a couple months ago with a 4% upside potential, and on the high end, a $115 price target from Citigroup, which would be a nearly 29% growth potential. The second trending stock on our list today is PPG Industries. They trade under the ticker PPG and are currently priced just shy of $150 per share. The company also pays a dividend with a current yield of 1.42%. PPG is the second largest producer in the U.S. of chemicals, architectural paints, industrial coatings, marine coatings, packaging coatings, and specialty materials. The company has been around for over 135 years, with operations in over 70 countries and about 47,000 employees globally. PPG is actually benefiting from the shift to electric vehicles, as they see a shift towards higher PPG product content per vehicle. With electric vehicles, their technologies include thermal conductive fillers, adhesives and sealants, corrosion and impact protection, dielectric protection, and battery fire protection. They're expecting 7 to 10 million EVs by 2025 and 25 million by 2030. PPG's most recent quarterly earnings report was back in July. Their net sales totaled $4.4 billion and were up about 45% year over year. Their adjusted earnings per diluted share came in at $1.94, which was significantly higher compared to 2020, and their cash and short-term investments totaled $1.3 billion at the end of the quarter. Now, just today, the company did lower their expectations for their third quarter results. They're now expecting sales volumes for the third quarter to be $225 to $275 million lower than their initial estimated figures. They said that increasing disruptions in commodity supplies, continued reduction in customer production, mainly due to shortages in semiconductor chips, and logistics and transportation challenges in many regions have dealt a blow to the company's sales volumes. So despite this negative news from the company, we have a bunch of analysts weighing in with reiterated price targets, and they seem to remain quite bullish on the stock. One of those analysts includes Deutsche Bank analyst David Begleiter, who said that their consecutive earnings miss was disappointing, but is due to transitory issues. The demand in Q3 remains robust, with inventories in many of its end-use channels at very low levels. We also heard from five-star analyst Michael Sisson from Wells Fargo, and he still sees double-digit earnings growth in 2021, supported by strong demand across the majority of its end markets, with 2022 earnings per share growth of high teens driven by higher volumes from recovering supply chains and potential restocking. While he is concerned that the downward revisions continue to be much larger than expected, the analyst suspects that PPG is not alone in facing these headwinds. The PPG industry stock does come in as a strong buy based on 12 buy ratings and 1 hold. The average price target of $185 would be an upside potential of about 23.5%. Taking a look at our detailed list of analyst forecasts, all of our ratings from this last week range between a 13 to 29% upside potential. And the third company on our list of trending stocks today is Callaway Golf. Their stock trades under the ticker ELY and is currently priced at $27.71 per share. Now, of course, Callaway Golf is known for their golf equipment and has a portfolio of global brands, including Callaway Golf, Odyssey, Ogio, TravisMathew, and Jack Wolfskin. Callaway has been the #1 brand rating by avid golfers since the summer of 2017. They also had the #1 driver on major worldwide tours and the #1 putter. They are also the company behind the sports bar entertainment driving range, Topgolf. Topgolf helps appeal to youth via their different games and social atmosphere. In fact, 51% of Topgolf guests have identified as non-golfers. However, 75% of these non-golfers who visited Topgolf said that they now have an interest in playing on an actual golf course. Topgolf now has 58 venues across the U.S. and has seen 21% annual growth in venues between 2017 and 2019. In 2019, Topgolf alone saw $1.1 billion in revenue. Callaway shared their latest earnings report about a month ago at the beginning of August. They came out with a quarterly earnings of 36 cents per share, which easily beated the estimates of a loss of 1 cent per share. The quarterly report represented an earnings surprise of 3,700%. Their adjusted EBITDA came in at $164 million, which was an increase of 466% year over year. But what really has analysts excited about the Callaway Golf stock today is that they just announced they're increasing their guidance for the third quarter and full year 2021. For their third quarter, the company now anticipates net revenues in the range of $850 to $860 million, compared with the prior estimates of $775 to $790 million. In the third quarter, they're expecting to report adjusted EBITDA in the range of $105 to $110 million, up from the prior estimates of $51 to $58 million. Following this update, we've had several analysts reiterate their price targets. The Callaway Golf stock does currently come in as a strong buy based on 5 buy ratings and 1 hold. The average price target comes in at $41 per share, which would be a nearly 48% upside potential. On the low end, we do have 1 hold rating at $33, which would still be a nearly 19% upside, and on the high end, a $49 price target from Jefferies, which would be a growth potential of 76%. So there are 3 stocks trending with analysts lately that come in as a strong buy with some very attractive upside potential. Now, I'd love to hear from you guys and your thoughts on these 3 companies. Were they on your radar already, and what do you think about their future growth? Let me know your thoughts in the comments down below. Please keep in mind that these videos are never a suggestion to buy or sell any specific stock and are just meant for information and entertainment purposes. Please make sure you always do your own research and due diligence before making any investment decision. If you made it to the end of today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Thank you guys so much for watching, and I'll see you back here next time.